Hello, everyone. Jason Gordon, residential mortgage specialist. Today is March 22nd, 2023. The Fed has met, the Fed has ruled, the Fed has spoken, and what they decided was to raise the federal funds rate by 25 basis points, or a quarter of 1%. But what does that mean? What's the context? Why should you care? I'm going to give you some visuals here in just a moment here, and we'll go over this really quickly to give you some context behind this, because you're going to hear all over the news today, all over social media, about the federal funds rate being raised. The Fed raised rates. What does that mean? Does that mean mortgage rates raised? Let's go over this really quickly here. So today, all of us mortgage professionals woke up and said, WTF, we need to watch the Fed today. What are they going to do? How is this going to impact the market, impact the clients who we are assisting? So one thing that you want to know, first and foremost, is that inflation is the mortal enemy of mortgage rates. As inflation goes up, mortgage rates go up. As it goes down, mortgage rates go down. I think we can all just look around and realize that inflation has definitely come up over this last year. Look at gas prices, look at groceries, look at the things that we are using on a daily basis. They are costing more money. Now, the Fed is raising the federal funds rate consistently in an attempt to curb inflation. And we'll get to that in just one moment. But look at this chart here. You'll see the white line up on top. These are mortgage rates. Below this, you see this is inflation in this kind of pinkish line. As inflation goes up, mortgage rates go up. As inflation goes down, mortgage rates go down. Now, this vertical shaded area you see right here, this is the recession that we had just before the global pandemic. Now, during this time, you see this new line that's introduced, this straight line right here. It's called the QE period. This is quantitative easing. This is when the government came in and bought an ungodly amount of mortgage-backed securities and essentially artificially kept mortgage rates down. A lot of us spoke during that time because I was quoting some really low mortgage rates, and a lot of you took advantage and refinanced your existing mortgage into a lower rate. Why wouldn't you? Made a lot of financial sense. And so you can see that during this period where the government was buying these mortgage-backed securities, mortgage rates stayed low despite the fact that inflation started to spike. Now, the Fed looked at this spike in inflation and they concluded this was transitory. It was going to end soon on its own. Boy, were they wrong. When they realized that they were wrong, they finally announced they were going to stop buying mortgage-backed securities, and they finally did stop buying them right here. And then, oh my goodness, once they stopped, look at the spike in mortgage rates. We've had a little bit up and down since then, but you can see just the impact of inflation on mortgage rates. And so when the Fed meets like today and they raise the federal funds rate, they're doing so to directly combat inflation. And so the Fed, when they change their federal funds rate, it works in lockstep with what's called the prime rate or the prime index rate. You may recognize the word prime if you have a home equity line of credit, which the abbreviation of that is a HELOC. All HELOCs are attached to the prime index. So if you look at both these charts, they're both telling the same story, just from a different data outlook. So you can see here in yellow, the prime was at 3.25 and it kind of flatlined for a few years. Down here, you can see the actual month and dates corresponding to that flatline period. The non-shaded areas, you can see it bounced around a little bit. Different amounts you can see are over here before it came back down and flatlined again, also at 3.25. But look at this green shaded area. Look at the specific numbers. It went from 3.25% in March of last year, 12 months ago, 3.25%. With all of these changes, we were at 7.75% today when we woke up. It's going to now change to 8% given the 0.25% rate change. But what does that mean to you? Let's get down to basics here. Let's say that you have a home equity line of credit. You're attached to that prime index that we just saw the charts on. Let's say that you have no margin. It's just prime is what you're paying, which some of you are doing that. Some of you have a margin that gets added to prime, but let's just keep it simple. You have no index. So you have no margin above your prime index. At 3.25%, your interest only payment on a $100,000 balance was $271, basically. You can see as the increases have occurred, what the impact has been on payments. With today's announcement, we are now at $667, about 146% increase in your payment for that same balance in just 1 year. So be very mindful. If you have very large home equity line of credit balances, you may want to be careful on that because these impacts could be very high. And most HELOCs have a life cap. In other words, over the life of the loan, the highest your rate can be a life cap of 18%. So I don't think we're going to get to 18%, but if you have very large balances in a HELOC and you're noticing the pinch on your payments, maybe we should talk about possible other options you have. It's a very scary pattern that we're seeing right now for those of you who have higher balances. Now, if you owe $10,000, you may not see much of a difference in payment. That's just math. But 100,000, 200,000, $250,000, you're going to start seeing some pretty big swings in monthly payment. Now, moving on, we believe definitively that a recession is imminent. I hear some naysayers out there. You're entitled to your opinion. That's okay. I'm going to give you some logic that I believe is going to support why we have a recession coming this year. Credit card debts are up on top on this top of this chart here. You can see leading up to the recession, we had increasing credit card balances, but then all these economic stimulus packages started coming in. People started getting these sets of money coming in. We're not spending as much money on leisure because they were all part of the pandemic or kind of sheltering in place. So people started paying down their credit cards. But since then, oh my goodness, look at this trajectory of credit card balances. Now, around the same time, we have on this bottom part here, personal savings account balances. You can see leading up to the recession and during the recession, we saved more money. We started saving less money and taking money out and a couple of spikes here and there. But look at since then, almost a straight line down. So we're saving less money. We're borrowing more money. We all know intuitively at some point, you max out your credit cards, you can't borrow any more money. At some point, you drain your savings account, there's nothing to pull from any longer. Heaven forbid both of those happen at the same time. The walls are closing in on you pretty uncomfortably. I know at least one bankruptcy attorney right now who is predicting he's going to be very busy in the coming years. Hopefully that's not going to impact any of you, but we need to be mindful of these trends. Now, some of you might say, well, wait a minute, Jason, we hear unemployment is at all-time lows. You can't possibly have a recession with low unemployment. Let's look a bit closer. Here we have more recession. This is a longer period of time. These dark vertical shaded areas are recessions. Look carefully at the unemployment rate leading up to each shaded area. Low unemployment followed by a recession and big spike. Low, big spike. You can see the trends before basically every recession, we have low unemployment. So all this news about low unemployment right now, it's actually supporting a case that recession is going to be imminent, not deviating from it being a possibility. And look at these spikes. This was obviously a huge spike during the pandemic. We've come down since then. Everyone's citing this drop down in unemployment. We believe this is a precursor to the next recession. Now, what do mortgage rates do during recessions? I hear all kinds of misinformation out there on the airwaves. Oh, a recession's coming. The sky is falling. Mortgage rates are going to be through the roof. Once again, that's not correct. Look carefully at these shaded areas. These are recessions again. I have highlighted here what happens during a recession and immediately after a recession. Look at the drop in rates in each of these recessionary areas and the time after these recessions. I mean, it's like clockwork. So if a recession is imminent, which I believe we have just made a good case for, and we know mortgage rates are going to drop, think about what that's going to do to the housing market. This could happen in the third quarter of 2023, which is basically the summer months when people tend to move more often anyway when the kids are out of school. So we have a low inventory of available homes, already a high demand of buyers. even though rates are higher right now. What happens when rates get lower? The media starts announcing it. People come out of the shadows, and now they're competing for the same home that you're competing for and driving that price up. And of course, if there's a bunch of people trying to buy the same home, that seller tends to not be very willing to make any deals or do any repairs because they don't have to. There's enough buyers. Someone's going to take the home as is and pay more than the asking price for. So why not, if you're looking for a home, consider buying now before the crowd forms. You want to buy when everyone's selling. You want to sell when everyone's buying. This is a great opportunity to get in now. You will lock in a bit higher mortgage rate now in exchange for getting ideally a seller that's willing to play ball with you. And then when the recession hits and then when mortgage rates drop, you have an ability to drop into a lower interest rate. Now, I have to say that there's always a chance we're wrong. I think that chance is very, very slim based on this data. Now, what is the market doing here right now? Let's break out of this PowerPoint just really quickly here and look at what's happening right now. It is currently 12:20 p.m., the day of the federal funds hike. This is Pacific time. This chart right here shows mortgage-backed securities. Okay, these green and red items you see on here are called candlesticks. Very simple to understand how to read these. I'll explain it to you in 20 seconds. Each candlestick summarizes the activity of the market for one business day. Yes, if you see me hover over this green one right here, you see down below in black, that's today's date. These go back, in this case, 3 months. Now, this is the playbook that every bank, every mortgage company in the country uses to change their pricing each and every day. Now, what is pricing? It's the combination of the interest rate you're paying and the acquisition costs, also known as closing costs that you're paying. By the way, if you have a quote, just the rate but not the closing cost, or just the closing cost and not the rate, then with all due respect, you're not making an informed decision. You got to have both. We lenders call that combination of the upfront costs and the interest rate. We call that pricing. So this is telling you what pricing is doing with the mortgage companies all across the country. As I explain this, I'm on your side. So in this case, green is good news for you. Red is bad news. The bigger the colored portion of the stick, the more the market moved in that direction that day as a whole. But here's the kicker. The higher the sticks appear on the chart, the better it is for your quote, the lower, the worse. And you might think, wait a minute, Jason, I want low rates. Low should be good. This chart is measuring mortgage-backed securities, which are bonds. Bonds and rates go in inverse directions. So just to make it real simple, up is good, down is bad, green is good, red is bad. So you can see today, in light of this quarter-point rate hike, the market is doing pretty well. We are actually up 33 basis points despite the federal funds announcement. So a lot of you think, or me are hearing, especially from a lot of the media out there, oh, they raised rates a quarter point. Rates just got worse for mortgages. You can see for yourself that's not what's happening at the moment. Now, we believe there's going to be a ripple effect from some of the comments the Fed makes about where they believe inflation is right now and this battle that they're having towards inflation. So that could rock the market more this week. But this gives you an idea of what's going on. Now, when you pull back to a longer period of time, you see this is a 3-month or last quarter. Look at the last 6 months. You can start seeing what's going on with mortgage pricing here. So we had a really bad run. We've had a nice little run since then, a little bit rocky here and there. We don't move in a straight line very often. When you pull back to a year or even 2 years, now we're picking up some of the pandemic. Look how high these sticks were over here. They came down a lot. And why did they come down a lot? Because of inflation. So long story short, to kind of bring this full circle, we believe this is good. The Fed is a bit behind in their approach, a lot of room for critiques. I'm not here to tell these folks how to do their job, and they're certainly very, very intelligent. At the same time, a lot of us believe that they waited a bit too long to do some of the things that they've done. However, today's rate hike of 0.25%, we believe, is going to hopefully put a real impact on the fight of inflation, drive us into a recession, bring mortgage rates down, which will be a great opportunity for all you folks to buy. Just for compliance purposes, here's my name again is Jason Gordon. My NMLS ID is 259027. A lot of my credentials are on this page right here, along with contact information for me right here. You can download my electronic business card. Real simple URL. It's vipborrower.com, vipborrower.com. Feel free to reach out to me if I can help.